Well, hello everyone, and I hope everybody's doing well. I wanted to take a few minutes to give you guys a really good idea of what goes inside an algorithm system. I know when I say algorithm, it trades mechanically, trades automatically. A lot of people still have this big question in their mind thinking, what in the world is it? How does it work? What are the parts that go into it? So today, I'm going to give you a very, very basic, quick idea of what goes into an algorithm or what goes into a mechanical system. I'm going to be very broad because I want to make sure you guys understand what I'm saying, but at the same time, it'll give you a fairly good understanding. Now, in the old days, technical trading systems were basically very simple. You would have an entry and you would have an exit, and it was a very linear type of a strategy. Buy when it breaks above a 20-day high, sell when it takes out a 90-day high. For example, I'm just making these rules up. But the point is, you're able to analyze the market based on what happened in the past using this data. But now, these systems, these engines to be able to test, they've gotten more complicated. They've gotten a lot more complicated. And now you're able to test multiple variables like fundamentals, technicals, all within one system. So to give you a really good example, we would start with technicals. We would begin with stocks that are, for example, making all-time highs. So this would be a first variable, the technicals. And we would look at stocks making 6-month highs. Then we would look at stocks making 3-month highs, and then we would look at stocks making 1-month highs, and then we would look at the average. Now, after we are done with that, and we pick a selected group of stocks, we would look at volatility. And in this example, we're looking at 3 assets. We're looking at the SPY, and we're comparing it with NVIDIA, and we're comparing it with Microsoft. And we would look at the correlation between these 3 assets. So, for example, you could see, let me just clear all of this. So, for example, in this study here, let me just give you a good example of what I'm talking about. We would get an idea of the S&P 500, and then we would compare it to, for example, Microsoft. All right, and we would compare it to NVIDIA, and we would compare it to Amazon. And the computer would do this, and the computer would do this automatically. And here's Amazon, for example, and it's comparing, and here's the other assets. But here you could see Amazon compared to the S&P. And what the system would do is it would test for correlation. It would see how close prices are mimicking each other on a large and a short-term basis. So, for example, if the correlation between 2 assets is too strong, the system may kick one of them out. So again, we start with relative strength. We see the assets that are gaining strength. Then we see the correlation between these assets. And again, in this case, you can compare, for example, Intel, all right? And that's Intel, and you can compare that to the S&P 500. But again, the machine does all this automatically for us. Then we would go to the third step. We would look at earnings per share. Earning per share growth versus previous quarter, and earnings per share growth versus previous year. And we'd want to make sure that both numbers pass our threshold. And we have a specific threshold that shows you these estimates based on a yearly basis. So for example, earnings surprises, we want to make sure our earnings surprises are higher on the past 2 quarters. We want to make sure our earning estimates are higher on the past 4 quarters. And we do this based on a certain multiplier. So the numbers have to be higher by a certain number going into each quarter. We find out when the earnings per share estimates are higher by about 20 to 30% each quarter, the stock price tends to move higher. So at this point, we've looked at relative strength, we've looked at correlation, we've looked at earnings per share surprises and estimates, and now we look to fundamentals. We look at filings, SEC filings. We look at 13F filings. We look at the 10Q report, the quarterly report. We look at all of these different filings. These filings tell us what the corporation is doing. It's telling us if insiders are buying. It's telling us how many shares insiders are buying. It's telling us which institutions hold which stocks. All of that you can find out if you know which fundamentals to look at. So again, I just gave you a very, very quick analysis, but and it's a lot more in depth. As a matter of fact, our storm strategy looks at 9,700 factors, over 9,500, between 9,500 and 9,700 factors. And some of the bigger ones that it looks at are relative strength or technicals on a stock, volatility between the assets, earning per share estimates and how much higher they are. And also another factor that it looks is analyst ratings. Not just analyst estimates, but analyst ratings. So for example, if the company has 28 strong buy recommendations and only 4 moderate buy recommendations and no sell recommendations, that's a company that mutual funds and hedge funds would look at in a very desirable way, and it would also tell us that there's institutional sponsorship moving into that stock. On another hand, for example, let me show you a good perspective. Look at Wells Fargo. Look at the recommendations. You've got 13 hold recommendations on Wells Fargo. If you look at the price of Wells Fargo, for example, you will notice that the stock over a period of several months has been going straight down. And if you look at the profile of the stock, you will see that the earnings revisions versus previous year have gone down. If you look at earning estimates, you will see that a lot of them are negative. See? Negative, negative. And if you look at analyst ratings, you will see that Wells Fargo has a lot of 13 holds. If you look at Amazon, on the other hand, you will see that the stock is going substantially higher. And if you look at the profile of the stock, you will see the numbers are very positive. You will see that earnings per growth per year per quarter are expected higher. You will see that earning estimates, look at that. Look at these numbers. All 4 earning estimates are higher, and the last 2 earning surprises is higher. And then if you look at analyst ratings, you will see that there's a correlation, 28 strong buys. So again, our system and our algorithms, they take into account technical factors, they take into account correlation, they take into account also volatility. Let me show you volatility. So let's say we're looking at Amazon. And let's say we're looking at Amazon. And let's say we look at the chart of Amazon. Let me put the ATR on here. This is called average true range indicator. And I use a 10-day. And you'll see here that the average true range here, whenever it goes down, this calculates the high-low, and it averages by about 5 to 10 days, depending on how many days. In this case, we're doing it by 10 days. You will see that volatility tends to pick up. When volatility tends to pick up, stocks stop trending. They usually slow down on their trend. So again, that's another factor that we may take into account, and we may want to pause or get out of the stock till volatility comes down again, and then the stock starts trending again. So the bottom line is we look at several factors. Now, if you try doing this on your own, it would literally take you probably a week to do each individual stock. Our algorithms can go through technicals, fundamentals, sentiment data, earnings analysis, volatility and correlation analysis in a matter of seconds. So there's a huge, huge advantage that goes into algorithm trading systems. The biggest is speed that allows you to test systems and test different strategies and test different factors that make up the stock in an instant. As I mentioned, we go through over 9,500 factors on each individual stock before we rank it. And that's the power that algorithms can give you in your trading, and they will outperform regular everyday people by a huge, huge margin almost every time. Hope that helps. How would you like to make 360% on Tesla, 484% on Nvidia, and 499% on Zoom? all in under 63 days? Now, if that sounds like that's something that's up your alley, then I've got a presentation that you need to watch right now. I'm revealing how I made each of these triple-digit returns and many, many more using an automated trading machine called Storm. I've developed Storm as a way to level the playing field against Wall Street and its lightning-fast algorithms. Now, I'm ready to reveal my research as well as five Storm stocks that could explode higher any day now. There's still time to get into each of these companies before their share prices rise, but you'll want to click on the button below and act now before your opportunity is gone.